Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. So here's the latest this morning. Minutes of the latest Fed minutes showing a hawkish tilt. Several committee members considering hiking rates due to sticky inflation. Terry Wizman of Macquarie writing the case for a rate cut was very weak already. It wasn't completely unexpected that the minutes leaned to the hawkish side. Terry joins us now for more. Terry, good morning.
Good morning, John.
Is there a case for a hike?
There is a case for hawkishness. Now, whether that translates into a hike or not, it certainly will not happen in the next few months. If there is going to be a hike, it's going to be a little bit further down the line this year, maybe in the fourth quarter. But let's talk about why there's a case for hawkishness, if not a hike. Optically, this is an economy, the U.S. economy, that has not seen inflation at target for 5 years. I mean, we have been persistently above that target. The other reason, of course, optically again, is that the unemployment rate is very low. If you consider what the Fed's two mandates are, there is no basis for not being cautious, which can translate as rhetorical hawkishness, as it did in the minutes. So that's the case, effectively, for a hike if you want to stretch it, but it's certainly the case for hawkishness without even the stretch. Keep in mind, one of the reasons we weren't surprised that even going into the meeting on January 29th that this would be a hawkish outcome, at least rhetorically, including from the presser that Chair Powell gave on that day, was that the composition of the FOMC changed at the turn of the year, as it always does. 4 members left and 4 members came in. And if you look at the disposition of the 4 members that came in, marginally more hawkish than the 4 members that came out, or more cautious, certainly. So this is not a surprise that there was a tone in the minutes that stressed the need to maybe even do away with the dovish bias implicit in the policy outlook. This is the case, effectively.
To your point, they're managing the optics. They're also setting us up potentially for a prolonged pause. Do you believe that pause expires with new leadership at the halfway point of the year?
So this is the market certainly believes that it expires, right? If you look at the forward curve right now in the money markets in the U.S. in overnight index products, it is suggesting that the Fed is going to cut twice. How can you suggest that the Fed is going to cut twice when they just came out with fairly cautious / hawkish minutes, when inflation is still above the target, and when the unemployment rate is very low? The only conclusion that one can draw from looking at that curve is that the market expects that there will be a structural break in the nature and disposition of the median opinion on the FOMC upon the change in the chairmanship. That's the only way that I can square that circle.
Yesterday, Nouriel Roubini was on with John and Lisa, and he was talking about how the Fed is not an absolute monarch, and Warsh needs to convince the rest of the committee. Can he convince the rest of the committee?
The market certainly believes that he can. There is no way I can explain that implied 50 basis points of cuts this year without the presumption that the market is making that Warsh can convince the committee. Warsh does have help on the committee, obviously. He has Chris Waller at the very least, potentially Michelle Bowman, who would look things his way when it comes to cutting. I want to make the case, though, that there is an intellectual basis for a cut as well, just as we just discussed an intellectual basis for a potential hike. And that is the case that Kevin Warsh has been making, which is that let's not look at the data. Let's not look at these optics. Let's just wonder about and think about what the implications of deregulation will be on the economy, what the implications of the AI revolution will be on the economy, potentially what the implications of reverse migration will be. But the first 2 things are the most important. The debate at the Fed going forward and the decision it will make will probably turn on what the median voter thinks about the AI revolution. That is going to get a lot more talk. There's going to be a lot more bandwidth at the Fed intellectually about what the long-term implication of this will be for inflation, for employment.
Well, what do you think? Do you think it's inflationary or disinflationary?
So I think it's inflationary in the short term, but obviously the promise of a disinflationary trend in the long term, once the investment is in place and it's deployed, is there. I think the people who are being cautious right now, even with respect to AI, let alone the optics of low unemployment and high inflation, are being hawkish because they actually believe that there could be an additional inflationary impulse in the economy over the next few months in view of all of the investment spending. Now, we're already seeing the effects of AI implicitly in the CPI. It's one of the reasons why electricity prices are high. So there is a case to be made for the short term. I think the doves, though, the structural doves, are also saying, hey, let's not, even if inflation is high in the short term, let's not worry about that. Because the benefit of running the economy hot for a while, in terms of the investment that you get in AI, will pay off in spades down the road with the disinflation it's going to create. And the inflation you have to tolerate now is the price you have to pay for the revolution that we're going to see in the next few months. That's another intellectual argument.
This is deeply sophisticated stuff, so forgive me for trying to make this very simple, but foreign exchange. Is the bull case for the dollar rebuilding, given everything you've just said, at least in the short term?
Not really, because in part the bull case on the dollar was not so much based on what the Fed was going to do. It was also based on where the dollar is in valuation terms, which is still very expensive from a long-term historical perspective. And the other case for dollar weakness, if you will, was the idea that the U.S. was disengaging from the rest of the world. And this would attenuate, it would start to fray the view of the U.S. dollar as the reserve currency and the international medium of exchange. If the U.S. re-engages with the rest of the world, I think there's a better case for a strong dollar there than with respect to what the Fed is going to do. And I will highlight that Marco Rubio's speech this past weekend could be that turn of events, could mark that turn of events that makes the U.S. re-engage with the rest of the world.
So is Marco Rubio dollar bullish and J.D. Vance is dollar bearish?
That's not a bad way to think about it. I guess what you need to consider here is whether or not Marco Rubio has managed to undo all the consternation that the U.S. received over the past year from its enemies, from its allies, from its erstwhile allies, from its future allies, etc. It's hard to say. We're watching the situation, but we want to see if the administration takes Marco Rubio's words to heart.
Stay with us. More Bloomberg surveillance coming up after this. Tensions very clearly rising between the US and Iran. US forces amassing their largest military buildup in the Middle East in decades. The White House maintaining a potential deal to avoid a conflict is still on the table. Ed Mills of Raymond James. Ed, we've often heard the president be congratulated for peace through strength. He has a means of doing things, a way of doing things. It's targeted, it's contained, it's high impact. Could this be a different approach?
Jonathan, it's possible, but I do think that the base case here is President Trump likes to escalate to de-escalate. He wants to put a lot of pressure on Iran. If there is a strike, he does like those quick wins. I think it's really important, the conversation we've been having already this morning on affordability. The president has a real issue already on affordability. If this does cause a market reaction, especially within energy markets, that is a very limited window that he has. And I think one of the big issues here is that when we go back to June, when we look at what happened in Venezuela with Maduro, there was a very clear objective and there was a lot of political support, maybe not necessarily kind of broadly kind of within the American public, but kind of within the policy circles, that this was a specific action that needed to be taken. I don't know what that specific action that needs to be taken right now, besides some of the conversations we've been having for years. Protesters, enrichment of uranium, kind of the nuclear program within Iran. What is the need right now to do this? I don't have that question.
And Iran is not Venezuela. This is an entirely different complex. What would be a quick win for the president then if he were to strike Iran?
Yeah, Anne-Marie, I would have to, kind of look specifically at what Israel has been talking about related to the ballistic missile capabilities of Iran. One of the big changes since October 7th is that deterrence is no longer the option. There is a much greater emphasis on offensive strategies. If there are concerns that the nuclear program continues to enrich, that they could be closer to a weapon that could be deployed via ballistic missile, taking out those ballistic missile facilities would be kind of one of those possible quick wins. Another attack on the nuclear sites is also possible if there's been a rebound, but that also upsets some of the conversations that Donald Trump wanted to have after the attacks of last June, that those nuclear facilities had been obliterated. So he does run the risk that if he goes after those, it opens the question, what was the actual damage?
And the question, of course, a lot of people are talking about how this might not be short-lived. This could be days, weeks, and even maybe months long. Ed, is there a potential that Donald Trump starts looking like George Bush? When you look at the Middle East right now and the U.S. military posture, it looks like 2003.
Yeah, so what we've told clients at Raymond James is that when we look at these geopolitical events, there hasn't been a huge market reaction because of the fact that they've been targeted. Those quote unquote quick wins have taken place. Anne-Marie, if we do go into weeks or months, if we start having those comparisons to the last time we've had major buildups in the Middle East, that would be a very different market expectation than what we have right now. So any conversation about comparisons is not a conversation this market wants to have.
Ed, how does he do this at the same time as he's going to give a huge speech today on affordability and potentially even the rhetoric coming out and moving of military hardware in the region without even a strike yet happening is pushing oil prices higher?
Yeah, what I would say is, so we have the speech on affordability in Georgia today. We're on tariff watch on the Supreme Court, maybe Friday, maybe Monday, maybe Tuesday. Tuesday night, we have the State of the Union address. So there is a level of escalation right in front of the time when President Trump is going to be in prime time on every single channel addressing the nation. And so I do think that there is some level of coordination between all of these activities and the military buildup that we see. We might not have a resolution before the State of the Union address, and that State of the Union address could be the thing that we're all watching to get a signal of what might happen next.
Do you think there's a chance he actually takes the strike before the State of the Union and then has this window into the U.S. public to explain why he did so?
It's possible. The State of the Union address is unlike any other opportunity of the year. Generally speaking, State of the Union addresses are well scripted, much in advance. They don't like breaking news. When you've seen breaking news, filter into State of the Union addresses, they come across disjointed. So from a kind of pure political perspective, you generally don't want to have those events right before these events. So maybe making the case as to what is necessary with Iran is maybe a better strategy, and having that ability to say the forces are in the region. It is up to Iran. We need them to denuclearize. I don't think they necessarily want to kind of be clear about what they want on regime change, because that's not a clear-cut outcome as well. High stakes on a very kind of important address, especially if he wants the message to be affordability, talking about kind of a major political entanglement and geopolitical risk is not necessarily what gives the president kind of any political tailwinds. It's a lot of headwinds instead.
Ed, can we finish on the Supreme Court and the potential for getting that decision before the weekend? The optics here could be very important. Do you think Supreme Court justices want to sit there in front of a State of the Union address after making a decision to strike down the president's tariffs? Is that something that they would have to consider going into the weekend?
It is, Jonathan, and what we've seen in the times past when the Supreme Court has made decisions close to the State of the Union address, presidents have almost wagged their finger at the Supreme Court, and there's been a conversation about, was that appropriate? We look back to the Citizens United decision, looking back to kind of decisions that the President Obama didn't like with the court. This would be something that President Trump takes very personal. He is someone that would be very likely to do this. One final thought on the Supreme Court decision, what we keep on telling clients at Raymond James is that it's an important decision, but the court might change the process. They are not going to change the outcome. Tariffs are here to stay. The president has a lot of other authorities. No matter what the Supreme Court does, these tariffs that have existed since April 2nd of last year will continue after any Supreme Court decision. There might be a little bit of a process change or a little bit of a hiccup in timing, but it doesn't change what the president is able to do.
Stay with us. More Bloomberg surveillance coming up after this. Let's turn to tech. Investor concerns over heavy capex causing sharp stock swings in recent weeks. Dan Flax of Neuberger Berman writing the capex debate is likely to remain an overhang in the near term, but we think the aggressive level of investment makes sense for some companies. Dan joins us now for more. Dan, welcome to the program. For many, for some, this is a great contradiction. How can this technology be this disruptive and upend software stocks, and at the same time the money being spent by the hyperscalers is said to be a waste of money? Dan, can both be true?
Good morning, John. Great to be with you as always. There are elements of disruption that are permeating the entire technology sector. Certainly in software, the questions around what models from the likes of OpenAI and Anthropic will do to those businesses. We actually see opportunities in the software sector, and I'll take Microsoft, which I think is executing very well. They are infusing more capabilities, agents into their software offerings. When we speak to customers, they look at Microsoft as an even more strategic partner than it's been in the past, given the opportunities. And then on the hyperscaler capex, if I look at Google spending $180 billion, you're seeing the results, John. You're seeing a search business they're transforming with AI Overview. Their cloud business is surging. And so I expect these cross currents to remain the focus in the near term. But I expect as we move through this year, the market will see the returns. It'll see businesses like Google, like Microsoft becoming more durable, which can help drive share price outperformance in my view.
Dan, let's talk about other beneficiaries and companies that just don't seem to be working right now, stocks more specifically. NVIDIA, flat on the year, down on the month, even though we're seeing these massive numbers come out of the hyperscalers. What gives?
The market's worried about a level of both deceleration in NVIDIA's business, given just how strong it's been. And of course, competition remains fierce. And so I like NVIDIA at current levels. What we're seeing is that they're executing incredibly well on their product roadmap, with Blackwell ramping as we speak, Rubin launching later this year. And so really the power or the magic, if you like, of NVIDIA is both the chips, the systems, and then the software. And so they are really a platform company that's laying the foundation for others to build upon. And so the vibrancy of their ecosystem, John, in my view, sets the company up very well. So yes, short-term concerns about growth. And of course, remember that there are capacity constraints. So I like the outlook for NVIDIA in the year ahead.
And they report next Wednesday. How high is the bar for them to clear?
The bar is high, but and I would expect that they're going to beat expectations. But the challenge for them is there isn't enough supply, and at the same time, there are questions around China, and China has been de-risked from their numbers. But the market's going to worry about the push and pull around the competitive forces, around a level of deceleration, and that I expect to be the dynamic into the spring. I do think, though, as we get more visibility on Rubin later this year, and really this continued broadening of their growth drivers, as you see opportunities longer term for NVIDIA in areas like robotics as one example, that will help propel the stock, assuming, again, continued strong execution on their product cycles, which we anticipate given the strong track record of Jensen and the leadership team there.
It's quite a track record, that's for sure.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.